Welcome back to the channel, guys. We're gonna do something a little different tonight, different than what we usually do. I don't typically give out trading strategies on my channel, simply because there's a million and one ways to trade the markets and um, make money. What I like to do is teach fundamentals, teach principles, knowing how gravity works allows you to figure out how to fly a plane, allows you to figure out, you know, objects in motion, things like that. So if I teach you a strategy, but you don't know the underlying things um, that go into it, you're just going to be following the strategy. I mean, and that's fine. You can do that and make money, but you can't ever think for yourself. And around here, I'm all about thinking for myself. I mean, that's why I started to trade in the first place. I wanted to put my mind against other people's minds, and that's what is rewarding for it. Um, to me, um, you can make a lot of money doing anything, um, and I mean, I just chose to focus on making money trading. So I try to teach fundamentals, but tonight I've been working on something, thinking about um, first principle trading. If you guys aren't familiar with first principles, it's kind of like, what do you know for sure? What do you what do you know for sure to be true, and then build from that, and just keep it simple along the way. So, what do we know for sure? So let's start with Bollinger bands. What do we know for sure about Bollinger bands? Well, they are a measure of volatility, and it's said that price 95% of all prices are contained within two standard deviations. And if you look at these bands, you have a center band. Above is a standard deviation, and below is a standard deviation. Okay. So you have two standard deviations. And what Bollinger Bands promises is that on two standard deviations, you're going to contain 95% of price. So you can see that if you look at this chart as I just scroll through it, there's not a lot of times where price comes out of the band. And if it does come out of the band, it returns to the mean. It reverts to the mean. Okay, so you're saying that this is oversold, or yeah, oversold at the bottom band, overbought at the top band, right? So what we know for sure, first principle thinking, is that if price comes out of this band, these times that it does is in the 5% of price movements, okay? Because the bands are going to expand and contract to contain price 95% of the time. That's two standard deviations. Now, if you take this up to three standard deviations, see how they expanded there? So now you have a standard deviation and a half on each side, which gives you three standard deviations, okay? This says that 99% of price action should be contained in this. And if you look at it, you definitely, like, you're really hard pressed to find an area where price came out here, came back to the band. Let's see if we can find other areas here. Came out here, back to the band. So these are high probability trading setups already, just using the bands. Okay. They're high probability because when price comes out of the band, something unique is happening. Okay. So we're gonna start there. We're gonna just layer this strategy from top to bottom. So three standard deviations, you'll get less signals, but they'll be definitely more reliable because it goes from containing 95% to 99%. Okay. You guys following me so far? If you are and you're enjoying it, give me a like, thumbs up. Appreciate it. All right, but we're going to change this back to two. Two is enough for me. Okay. Um, then, so we're going to look at areas where it comes out of the band. I don't want to be scanning. If I'm looking at multiple charts, I don't want to have to look and zoom in and go, is this outside the band? Did this close outside the band? I don't want to do all that. So Bollinger Bands has a has a little helper here. It's called the Bollinger Band percent B. Okay. What it simply does is it gives you the Bollinger Band, but it gives you um, a different representation of it. So this line here is where price is inside the band. The 50%, and we're right here. It's not 50%. Let's make it 50. Oh, yeah, it is. Okay. So the 50% is the moving average in the middle. You guys see that? And every time it has 50 points above and 50 points below. So whenever it's above 1 or below 0, it's outside the band. All right. So this will help you with spotting areas more quickly as you're scanning through charts. You know, if I just flick through a bunch of charts, I can see when things are out of the band, when prices are out of the band, just by looking down here. Because if it breaks this line here or this line here, and I see that, I look at these areas and I can see when they're out of the band. So that's going to help with back testing, and it's also going to help you real time. All right. So we're going to add two more things to this. We're going to add volume, of course. Just did a video on VSA. You guys know how important volume is to price movements, to predicting them. And we're going to add one more thing here. So if you are in an uptrend, okay, and price exits the band, the trend is up. Would you sell at the top of a band? Would you think that would be a good idea if price has shown you that there's aggressive buying and it's moving up day after day, minute after minute? It's just moving up, moving up. Would you want to sell into that market? Well, I hope you answered no, because you wouldn't want to, because you would be playing counter trend. Now, I know a lot of traders, I wouldn't say a lot, I know like two or three. I know a handful of traders that trade counter trend, and they're very good at it, but they've honed that skill over time, and it's just easier for you to be able to trade with the trend whenever possible, because that's where your biggest moves are going to happen. You can trade counter trend, okay, but you have to understand that those moves that are counter to the prevailing trend, they're going to be a lot shorter than the trend moves. See how big this move is, this impulse here? Pull back, a lot shorter. This impulse, pull back. Look how short that is. Okay. And we can just keep going. Impulse, pull back. Until the trend starts to change direction, the impulses, the impulse waves in the overall trend are always going to be um, wider than the pullbacks. That's why you see markets moving like this. Okay. So you can live your life. You can live your life inside of here. That there. You can live your life inside of here, trying to catch these and make a living off of these. Okay. And it can be done. Like I said, I know people that do it. Or you can live your life trying to catch the impulses, the big moves, when the market takes a breath and then takes off again. Okay. And in order to do that, you're going to have to follow a trend. Okay. You're going to have to be in a trend. This is clearly an uptrend. You can trade the downtrend here, this small pullback here, but understand that your money and your odds are the best when you're in an uptrend. So as far as selling the bands when they approach in an uptrend, you don't want to be doing that. That's not what I want to teach you today. All right. So let's look at this. So how can we filter out which direction of trade that we should be taking? We're going to do that by adding a moving average, a longer period moving average. And we're going to add a 200 period moving average. All right. So this Bollinger Band is a 20 period. This is a 200 period. We're going to make it big and yellow. Okay. So now you can see the overall trend over the last 200 bars. Okay. There's 72 5-minute bars in a day. Okay, so you're basically going to get 2.5 days worth of data in any point on this. So that's pretty good if you're on a 5-minute chart. Obviously, if you're on a 15-minute chart, it's going to do 215-minute bars, which is going to be 3 times this. So instead of getting 2.5 days, you're going to get 7.5. You guys get it, right? So the thing is, we only want to be taking um, trades that are in line with the 200 period moving average, which means if we are above it, we are bullish. We are bullish, and we only want to be taking lower band breaks back to the middle. Okay? We only want to be reverting back to the middle if we are above the 200 moving average and we have a lower band break. All right? If we are below the 200 moving average in price, let's find an area here. We're below the 200 moving average and we have an upper band break. Because we're below the 200 moving average, we have a downtrend in effect. All right. So we only want to be looking to trade in the down direction. All right. So now we know two very important things. We know what the trend is, a long-term trend, so we can trade in that direction. And we know that when price gets out of this 2 standard deviation, that it tends to revert back to the mean. Now, that doesn't mean that it can't come all the way down here, because that happens a lot. But we don't need that whole movement to be profitable. We want the high probability movement, because how many times do you see price bounce at the 20? A lot, right? So we want the high probability movement. We just want it back to the 20, from the top of the band back to the 20. Okay. So when the strategy is, when this band, when you close outside of a band, you're going to be taking the 61.8% of the candle retracement back. That's going to be your entry, and your stop's going to be below that candle. All right. So we're just going to do, this video is already pretty long. Where are we at? I don't see my timer, but I think it's pretty long. So we're just going to do a couple of examples. I have back tested this. The win rate was about 70%. So it had a very good win rate. But I tested that on the 50% retracement of the candle. And we're going to do the 61.8% because that's a Fibonacci number. Okay. Won't get into that. I don't typically believe in Fibonacci. And I know what you're thinking. Why the fuck would you give us a strategy you don't believe in? But I want to make this as mechanical as possible. 61.8, 61.6, and the 50% are both Fibonacci numbers. And I want to make it something that I can repeat over and over. I can just be mechanical about it. So that's why we're going to do the Fibonacci, okay? So let's check this out here. Let's go to a random, just keep clicking around. Let's go to a random stock that I haven't seen. This one here looks nice. All right, so we have our filter of this moving average. Let's go back. All right, so we're above the moving average. So what are we looking for right here? We're looking for times when price breaks the lower band, closes outside the lower band. Remember, we want to close outside of it. It can't wick it. It can't wick and come back in. It has to close outside of it for it to be a valid entry, okay? So we see here, it's outside the lower band. You see that? This closed outside the lower band right here, okay? But we had an entry before that. So we're looking here, we're looking here. We had an entry right here. Right here. This was the first time it closed outside the band. I'm not going to pull out the Fibonacci yet because, well, I can do it. It's really simple. I've already set it up. Let's do it. So we take it from the high to the low. Okay. And I've already customized it to tell me when 61.8 and 50% is. So we want to enter here. Okay. When it breaks above here, we want to enter here. But it never gets there, so we're never in that trade. Let's take the next one. The next bar that closed outside. Where's the 60%? Okay, so this actually did trigger an entry. So we're going to go long entry here, here. And we're going to put our stop below there. All right. Once this bar moves on, however, we no longer concerned about this bar because this low, if price was going to come up and trigger you in, you don't want it to trade back below this bar. Okay. So if you see this bar close outside the band and you didn't get in because it never triggered you, as you can see, this never made it up to this yellow line here, so we never got in. You just move on to the next bar. It's still outside the band. Move on to the next bar. Okay. Now, we don't know how this candle formed here. We don't know if this candle ran down first, if it opened here and ran down and then ran up to get us into this order. Okay. But that part's irrelevant. We don't need to know that because we lost this trade either way. So if we were in this order here and we put it here, at the end of this bar took us out of this trade. Okay, you see that? That bar took us out of that trade. So it wasn't important how that bar formed. So we move on. We've now lost one trade. I'm going to put an X here. We lost a trade there. I'm going to do a couple more. Okay, when we lost this trade, what did we lose? We lost 12 cents on this trade. So we lost 12 cents. Oh, come on. I should just use text box. Okay, minus 12 cents. And you have to be, of course, a different color. All right, so we lost 12 cents on this trade right here because it would have come out and stopped us out of this trade. We would not have taken this. We would not have taken this trade right here, this bar trade, because this bar trade was included in this. Okay, if we had gotten in here on this bar, this is the entry bar here. This bar right here would have been part of this, and then this bar would have taken us out. But we could have potentially gotten in here on this bar because this would be a new trade, right? So once this bar closed, we take the same Fibonacci, we bring it here, and we wait for price to retrace 61%, and we would have gotten into this trade right here. Now, this gapped up overnight, so unless we were trading pre-market, we would have missed this trade. But as you can see, let's say that it didn't gap up. Let's see, long position, and we got in on this bar right here. Risk down here, risk at 18 cents. We would have gotten 23 cents out of this had we just mean reverted, had we just took it back to the 20. Very high probability it was going to come back to the 20, right? So we're going to count this because this video is already pretty long. I'm going to say this is plus 23 cents, right? So we're already net plus 11 cents, right? Let's move on. Let's see if we can get 3 more in here, and then that'll be the end of the video. We're above the, delete some of this clutter. We're above the overall moving average. So remember, we're only looking for lower band breaks because we want to see buying to continue the uptrend. All right. So this is going to keep us honest. So we have one here. This closed outside the band here. You see that? You see it down here? Close outside the band, big time outside the band. So we know that only happens 95 or 5% of the time. We're going to take our fib retracement. We're going to put it right here. Okay. We never get triggered in this before this candle forms a new low. This candle never trades up to 68% of this bar. So we're never in this trade here. So, okay, that's fine. We take this one here. We go here with it. This whole body of this bar closes. Okay, we're looking for, we went the wrong way on that one. I gotta go down. It's a down bar. Whatever the direction of the candle is, start in that direction. So if it's a downtrend, start at the top and go down. If it's an uptrend, start at the bottom and go up because you're 68%. You wanted to be on the right side of the bar. Okay, very important. I'm glad I did that. I forgot to mention that. Okay, so here, this bar here, we've now taken the whole range of this bar, you see, from the top to the bottom. Okay, 68% right here. We're above the moving average, so we can take this buy here. So we buy right here. We put our stop below this low, and we just want to take this to the moving average, and we get there really quick. We get there in 10 minutes. See that? We get there in 10 minutes for plus 26 cents. All right. So that's a win. I'm just going to copy this, bring it over here, and turn it to 26 cents. That's 26 cents. Two more. I'm going to do two more, guys. This is not outside the band, even though it came outside, but it didn't close outside, and you know that here because below, it's not below this line here, right? All right, so let's just look for areas where it's below this line, and then we'll decide if we can take it. So here it is below the line. It is below the line here. And what do we have? Is it below here? It looks like it's below right here. We are above the 20 or the 200 period moving average. So we could take this here to here. Okay. You never are in this trade. You're never in this trade because you see it covered 61% of this bar and never came back until you would have been in the wrong direction. So this trade is a scratch. I mean it never happened for you. You were outside the bar, the band here. It never retraced enough for you to get in. Okay. So let's keep going, see if we can find another one. We have one here. Looks like here to the downside. It's outside the band here. I think this is going to be the same situation where you never get triggered into the order. Yeah, you never get in. You almost do, but because the rule's so mechanical, you're never confused. You see this? This is the 50%. My old strategy would have got us in. My other one would have got us into this, but because we bumped it up a little bit higher, 68%, we never got in. You guys see this wick here? This yellow one would be where I put my alert to watch for an entry, but this is where I would enter. So it never got up here. I never got in that trade. So it kept me out of that trade, that rule. And now we are below the moving average. So none of these we can take because we didn't have enough momentum to stay above the 200. Okay. So we're not going to be taking buys now because it's showing us that price is weak. All right. And then we break back above it, but we can't take any of these because now we're above it. Okay. We're not looking to sell back to the medium to the band because we've now confirmed that the trend is up yet again. All right. So let's keep going till we find something below the band but above the moving average. Here's one here. Jumps out at you here. You can see this is below the band here. See that? So we take our Fibonacci tool. We go below to low. And we take a long position at this area here. Okay, we would have definitely got it, and we put it right below here. We're risking 9 cents, guys. Look at that. Look at that stop. Risking 9 cents to take it back to the moving average. As soon as you get back to the moving average, you're out at 16 cents. All right, you're out on this candle right here because it wicked it. Your order would have been here. It would have had to trade through your order to get up there. So you would have been out here. All right, now a lot of these you're going to look and you're going to see, well, it does run to the other side of the band, and that's a lot more. And that'll be up to you if you decide to keep that trade after it hits the band. Maybe you put your stop here and it continues to run up for you, but you get the minimum here. You know, that's something you can play around with, and you would have to use a combination of volume and other, technical analysis to see. But the most probable move is back to the band. And this works on all time frames. All right. All time frames I've tested this on and it works. So if you want bigger moves, Go to a bigger time frame. This is only a 5 minute on an $85 stock. You want to put this on Tesla on a 15 minute, you're going to be catching $10, $20. Okay. You're also going to be losing that when you lose, but you're going to be catching bigger moves. So we would have gotten 17 points on this one here. 17 pennies. Okay. And we're going to do one more. Let's see. We're outside the band here and above the moving average, above the 200. We're going to take this Fibonacci. We're going to take this down here. Okay, that's the 61.8 there. We're going to go long position here, put it right there. We're going to risk this bar right here. So this wick here, the bar closed here, opened here, probably sold down. That's why you got this wick, and then came up, got us in the trade. All right. And we did not get back to the moving average on this before we were stopped out. We were stopped out right here. When we were stopped out, we only lost 8 cents though. So minus 0.8. So let's add these together now. We got minus 8 cents plus 17. So we're minus 9, or we're plus 9 cents now, plus 17. So plus 9 cents, plus 26 cents. So plus 35 cents. 9 plus 26 is 35. Plus 23 cents, 35. Plus 23, what's that? 58 cents, and then minus 12 cents. So 48, 46. So net, we're plus 40. What did I say? I don't want to do all that math again. Let's just say 46 cents. Now, that doesn't seem like a lot. You're plus 46 cents. But you just multiply that by however many shares that you have. And that's what you made on it. You have 1,000 shares. You can buy 1,000 shares of this with, day trading margin. That's $460. Now this is just one stock. I'm not saying you got to trade next Era Energy. I don't even know what the hell they do. You could do this on anything. But this video is going to be really long, so I'm not gonna do it on everything. But just wanted to put this out there. I'm going to be testing it out. I haven't seen it fail. It's definitely a higher win rate once you put these things into place, these parameters that you can use. And you see it. I mean, it happens a lot. Look at Tesla here. Look at Tesla right here. You got this here, traded outside, closed outside. Okay. That's the 61.8% retracement of this entire bar, not just the body, the entire bar, right? Long position here. You put your stop below this low here, and you just take it back to the band. Bam. You got a $10.68 trade right here. And you're only in this trade 1, 2, 3, 4 minutes. Or 20 minutes. 4 bars, 4 5-minute bars. High probability return to the center line. Okay. You could have put your stop there once you got there, but you would have been stopped out. It would have came out and got you out of there. So this would be high probability, but you want to take it all the way to the other band. That's your prerogative. Like I said, I don't give a lot of trading strategies on here. So whenever I give you one, don't use it how I use it. If you improve it and leave me a comment. Let me know. All right. This video is long as hell. Thanks for watching. If you watched to the end, if you give me a thumbs up, subscribe, I'd appreciate it. And I'll see you guys in the next one. Peace.